Hello and welcome to post-budget episode of Simply inTAXicating. It's going to be almost 2 weeks that the budget is out. So it's safe to presume that the industry experts have not only read the finance bill, but have also read between the lines and now ready to explode with their reactions. There are 238 amendments in the finance bill and as many as 142 amendments in the direct taxation sphere, be it the black money declaration scheme, the dispute resolution scheme, rationalization provisions, and so on. Today, in this episode, we are going to revisit the finance bill and understand it from our experts. What are the hits? What are the misses? Whether the amendments are living up to the expectations of the industry or not. Today in our studio joining is Mr. Sunil Chopra, former Chief Commissioner of Income Tax. We have Mr. Sant Kumar Verma. He is the Country Director Taxation, Schneider Electric Private Limited. We have Mr. Rohit Jain, Partner, Vash & Associates, and Mr. Sunil Aggarwal, Senior Tax Partner, AZ&B. Let me begin with Mr. Rohit Jain. Now the whole world knows about the amendments and some of them have been rightfully welcomed also. I want you to focus on those changes which is going to hurt the trade and the industry.
One of the main change which is going to hurt the trade and industry is the TCS being imposed on the sale of cars above 10 lakhs. So every sale of the car will attract TCS. Now the sale of jewelry and the sale of items above 2 lakhs also will require to collect the tax at source. So this is obviously going to affect the trade. Then I don't think there are many changes which are going to affect the trade and the commerce as such.
Mr. Aggarwal, your views, just holistically if you can.
In brief, I would say that the present budget represents a clean break from the past. Earlier, the budget used to be an annual exercise of disbursing doles or refusing doles. This time, it has been a very sensible economic exercise wherein the funds, the income of the government has been kept in mind, and the end out of that, the allocations to priority areas has been very distinctly visible. So overall, and the finance minister is very, very particular about maintaining the fiscal balance.
You have been a former IRS officer and now a part of the common man. So can you share both the perspective? One from the revenue and from the common man perspective, looking at this budget.
I find that this is a very, very focused budget, a very positive budget with a lot of emphasis on revenue augmentation. The surcharge has been increased in the case of individuals and HUFs from 12% to 15% when the income exceeds 1 crore rupees. Then tax has been brought on dividends exceeding rupees 10 lakhs. Another thing which is not there in the budget but is very, very clear, that finance minister has successfully resisted the temptation of enlarging the exemption limit, because there was always a pressure, and we understand that last time when the exemption limit was raised by just 50,000 rupees, 1.65 crore of taxpayers out of our taxpayer base of 3.38 crores went out. So it hurts not the tax base as well as revenues. Then he has laid out a very definite roadmap with regard to phasing out of deductions and exemptions.
Mr. Verma, you are from the industry, you have spent so many years there. So, any pains, any gains for the industry? Maybe you can share with us.
I think overall, as all the other panelists have mentioned, it's a very good overall balanced budget. There are only two things which, from industry point of view, one would like to point out. One is there was great expectation on the corporate tax reduction for everybody, at least by 1 percentage point. It happened for certain categories, which is startup and new manufacturing, and the small entrepreneurs having income of less than 5 crore. But it did not happen for the rest. Second, while there is a rationalization of penalty provision, which is good, I think it brings some definitiveness in the way it is implemented.
We'll discuss that penalty provisions in details.
But I think I see some pain over there that it kind of becomes mandatory 50% penalty for any income which gets unreported. So any clerical mistake or any genuine mistake or difference of opinion with the officer would latch you with a 50% penalty, which I don't think is a good measure. So the men's-free as a concept should continue to be the basis for penalty and not
basis for penalty.
mere underreporting. Yeah.
So now we'll move on to the specifics. Now coming to a very contentious issue that last year we had, that Foreign Black Money Act voluntary disclosure income scheme. This year also we have come out with another scheme, and last year's scheme generated so much of decibel, but we could garner, I think, around only 4100 crores approximately. This year the focus is on the domestic black money income. Do you think these measures would actually be, be able to achieve the objective? At least looking at the figures that we are collecting through the schemes, do you think they are serving any purpose?
I would touch upon the issue by two perspectives. One is the VDIS now and what was in the past. Some distinctions. Two, what is the objective now as compared to the past. And at the moment I am confining myself only to the domestic income declaration scheme. Now in the past, as all of us know, Chopra Sahib is here, so he knows, we had VDISs in 1951, in 1965, in 1977, in 1981 that bearer bonds, 1987, 1991 again some remittance scheme, 1997 again VDIS schemes. All those were not great successes, but the point I want to highlight is that in those schemes, government was before the tax evaders with a begging bowl. Government did not have the capacity to catch them. It was just asking them to give them some kind of a largesse. Now the situation has changed. Now the government and because of computerization, because of a whole lot of voluntary reporting or compulsory reporting of data to tax department to the government has all the information with it. It is being processed, and therefore in future the people cannot perhaps afford to keep black money.
Point again. Mr. Chopra, your views, and also a small question that they have very interestingly put it in the explanatory memorandum under the head of ease of doing business. So what message exactly government wants to convey? A voluntary disclosure of income scheme, that too, for black money, that is under the ease of doing business head. And it's almost becoming a trend now. Every year we are coming up with such schemes.
No, I very strongly feel that it has been misclassified under that head of ease of doing business. An amnesty scheme just cannot be part of ease of doing business. So it should have been classified separately. Now, coming to the merits of the scheme, the efficacy of any income declaration scheme would ultimately depend upon the capacity of the income tax department to catch the tax evaders. Now,
so you're saying the deterrent effect is there and people would be forthcoming.
Right now, the department has got a lot of data relating to the taxpayers, but the data mining is not adequate or effective. So that needs to be strengthened. But coming to the merits of this scheme, commission after commission has been recommending that this kind of amnesty scheme should not be brought because it acts as a disincentive to the honest taxpayers. The latest Tax Administration Reforms Commission, which gave its reports during 2014 and 2015, had clearly recommended to the government that such a scheme should not be brought. And in this point-wise reply which CBDT has given to the implementation of recommendations of TARC, with regard to this recommendation that amnesty scheme should not be brought, CBDT has replied, which is there on TIOL site also, that no such scheme is under consideration of the government. And still, this kind of scheme has come.
So, Rohit Jain, I don't want you to go into the conceptual nitty-gritties of this scheme, but what is your views? Is it going to serve any purpose? What exactly are we going to achieve out of this scheme? That's the larger question which I want you to answer.
I think something which has been missed out is what is important. I think the concept of this government is that we are going to give you a one-time option. It's a one-time declaration scheme, which was similar to the one which was given under the Black Money Act for foreign undisclosed assets.
Correct.
You come out, declare and come clean. Thereafter, we will not give you an opportunity. That's the concept, I think, from where the government is moving on.
Okay.
Now, what is important to know is that there are two kinds of undisclosed income which has to be disclosed. One is in the form of cash, money, etc. Second is the asset. Now, what is important to notice, in so far as the assets are concerned, they are taxed under the scheme at the fair market value as on first. So, what we will have to consider is the fair market value of the asset and not the actual cost which was invested at the time of acquisition of the asset. The second thing which is very important to note and which probably has been missed out is, if you see the scheme, this is given under chapter 9 of the finance bill. It's not part of the Income Tax Act per se. Under the act, there are certain limitations governing the assessments of the income, which is 6 years under the present act. Now, what the scheme says is, supposingly you declare the asset, but ultimately you don't pay the tax, or subsequently the assessing officer comes to know that you have undisclosed income or an undisclosed asset, he can issue you the notice and tax you that income or an asset in the assessment year in which he issues you the notice. So what basically they are doing is, they are doing away with all the limitations which are available under the act. Now the larger question which now comes is, whether it would be right on the part of the assessing officer, or whether they have that kind of a power to go beyond 6 years, even though there are limitations contained under the present act. So these are larger questions which probably has been missed out of by many, that the scheme says that once you don't declare it and subsequently we find it, then irrespective of the limitation period, we will go after you, we will tax you at the normal rates.
Override the Income Tax Act.
So this is a very larger question, in fact, that is going to come in future.
So, and the panelists on my left hand side, they are in favor of the scheme and Mr. Chopra is against. What's your view on this?
I look at this as a citizen of the country. We all know that there is a black money which gets generated every year in this country. So this debate over tax morality beyond a point loses all steam in my views. If 5 schemes have come post independence so far, still we continue to create black money and so on and so forth.
Absolutely.
So there is a practical reality which I think we need to acknowledge as citizens. Government is already acknowledging by putting up this scheme forward. I think they have kind of to some extent ring fenced, as Rohit mentioned, that in the normal course, beyond 6 year period, under 148, in any case you can't issue notices, even if you find out that he is a person who accumulated black money 20 years back or 15 years back. You can't do anything about it. Even if even if somebody comes and declares that 10 years back I did something, you can do nothing about it.
Period kicks in.
So keeping all of these realities together, I think it's a good scheme.
I'll stick with you only, Mr. Verma. My next question for you is that, being in the industry, you have seen this demonic rising graph of tax litigations, and it's almost breaking the back of the judicial system and the businesses. In this finance bill, they have proposed a new dispute resolution scheme, and the finance minister in his budget speech, he has referred to a gigantic figure of 5.5 lakh crores, which is stuck at the first appellate level in around 3 lakhs cases, which if allowed to go up the ladder, I mean at the tribunal level, it will certainly choke the tribunal, which is already burdened by 1 lakh pending cases. So you have gone through this scheme. Do you think it has the potentiality, it has the power, the capacity to bring change, to reduce this demonic rise of graph of litigation?
There are 2 points which I would like to touch upon. One key point which was also part of the TAC report of Dr. Shom committee, that how we make our officers independent and strengthen them to take decisions. I think that's, in my views, as an SSC, I can now say this with a lot of confidence, that the key reason why we have so much of litigation, because the officer out there, whether it is in indirect taxes or indirect taxes, is maybe partly scared, and all the time he is not impartially, independently taking decision while passing the orders. If we do something systematically there to take care of this issue, which it's a long-term issue, and it has been spoken at length in TARC. So this is one measure which I think government is trying to address in its own way. Second, specifically to the scheme that they have announced, in my views, I think this would be more helpful for the cases which are more frivolous appeals coming in, being filed by people to just avoid or delay the payment, because at the end of the day you end up paying only 12% interest if there is a delay. So I think it's an opportunity for those, if there are frivolous appeals filed at the first appellate level, you pay and then move on in life, and government also gets their money, and then you save on penalty and all of that.
So, sir, from the revenues perspective, do you think the scheme has been well drafted, well crafted, and given the required look, the strength to handle this rising graph of litigation? Or something has been missed out?
Now, so far as the rising graph of litigation is concerned, vis-a-vis this scheme, taxpayers who will come and try to take benefit of the scheme are those in whose case either additions have been made for the first time, or if additions have been made in the past and they have lost at the higher levels, tribunal or high court, they may come forward and make use of this dispute resolution scheme. So far as those taxpayers are concerned, in whose cases for earlier assessment years, they have obtained relief from the higher appellate authorities or judicial authorities, they will not like to take advantage of this scheme.
I'll stick with you, sir. The finance bill is phasing out the deductions in a phased manner, and it's been already debated. It was there in the public domain, so it was not unexpected. But looking at the sunset clauses, do you think this is going to hit the industry? Limiting the accelerated depreciation, doing away with the deductions in the SCZ, that's Section 10AA. So do you think that, or I would in fact also ask that if this, these deductions will now trigger, from the 2017-18, so the government will have certain savings. So can an inference be drawn that there will be a reduction in corporate taxation maybe in the next budget with this extra savings with the government?
In fact, there has been a reduction even this year from 30 to 29% in case of those corporates who have a turnover during financial year 2014-15 up to rupees 5 crores. And commensurately, there has been no phasing out of deductions for the financial year 2016-17. Now, coming to the question as to with the phasing out of these deductions, will it affect the industry? There is a larger question. Why should an Income Tax Act, which is essentially a fiscal statute, should be largely used for achieving socio-economic objectives? The one reason why the administration of direct taxes has become so complex is the multiplicity of these provisions. First, you bring a tax concession, then problems arise of interpretation, then there are
eligibility issues,
litigation disputes, lot of amount is held up, and then the government has to come like things like MAT. If the government wants to encourage certain industries or industrialization of certain areas, it can come with direct subsidy rather than giving the benefit through the Income Tax Act.
Mr. Rohit Jain, my next question is about this charitable institutions, and we all know, charitable institutions are globally considered as a vehicle for either tax shelter or I may even so tax evasion. There is an interesting concept of exit tax which is now going to be imposed on the charitable institution, and in fact more interestingly they have put it under the chapter of in the explanatory memorandum on anti-abuse measures. So would you like to share, how deep-rooted is the misuse of the provisions by the charitable institution that the government was compelled to come out with this measure? Are there any specific recent instances or any judicial decisions which actually led to this? If there are any, maybe you would like to share.
There have been controversies with regard to the utilization of the assets of the trust for non-charitable purposes. I think with that in mind, and there have been recent judgments wherein they have said that if there have been violations in the current year, then you cannot, seek to tax the accumulated income which has been accumulated over the last earlier years.
Correct.
So with that concept in mind, in fact, the finance minister also referred to that there have been judicial precedents that you cannot tax the past accumulated amounts or the assets which are there in the charitable institution. So what they now seeks to provide is that in case the charitable institution becomes a non-charitable institution by maybe merger of the institution, by changing the objects for which it originally was set up, it provides that you have to pay the maximum marginal rate of tax on the accreted income, and the accreted income is basically the fair market value of the assets of the trust which was there on the specified date, which is basically the date on which you cease to be a charitable institution. So it is basically to get over the lacuna which was there in the law, that earlier in case of becoming a non-charitable institution, that amount, that the fair market value of those assets which are accumulated and available in the trust were not brought to tax. to get over that lacuna, they have come out with this exit tax. And in fact, you will notice there was a similar proposal under the proposed legislation, which was to, take over the Income Tax Act also, wherein also a 10% tax was sought to be levied on the charitable institution if they were not to avail the tax exemption. So this is something similar to that kind of a levy. I think so far as the concept is concerned, this is a fairly welcome concept. The only thing I think which they have probably missed out is that there is no specific provision for levy of the exit tax where the registration is withdrawn on account of violation of section 13. So because there has been amendment in the act which says that the registration per se can be withdrawn by the prescribed authority if the charitable trust violates any of the conditions of section 13. For that specifically there is no amendment to levy exit tax.
The next question is about the villainous, the notorious, the penalty provision of section. The question is for you, Mr. Verma, section 271(1)(c). So, we have been in the industry, we have seen in almost every case, the penalty is being imposed irrespective of the fact whether this penalty is sustainable in the court of law or not. So, that section is being recast now in this finance bill. How do you see, the provision? Is it going to serve the purpose?
On one side, their intention seems to be to take away the discretion because you have 100% to 300%. And as you rightly said, in practically every case, you have at least 100% getting proposed. And maybe in 99% cases, it gets thrown away at the higher forum. So they want to bring in definitiveness in the, for the officer also that if this is the situation, it's only 50%, otherwise 200%. Now, but when we look at these percentages and what acts would attract this 50% or 200%, in my views, since this is all under the overall garb of rationalization of or ease of doing business, I see a scope of truly rationalizing this. I don't see any sense of this 50% being imposed for underreporting. There could be numerous reasons for underreporting. As long as there is no bad intention or mens rea, penalty should not be there. So the pedestal to have penalty which used to exist in the 271 C and all of that, that should remain in my view. So mens rea should remain. So 50% to me doesn't make too much of sense. Second, should we have 200% in case there is a willful evasion? I think that's still too harsh. So if you look at all the indirect tax laws, these are all central laws. I'm talking about service tax, central excise and customs. The penalty is 100% there. You have 25% situation, you have 100% situation, but it's not beyond 100%. And that 100% is only in case of malified intention, not otherwise. So why can't we stick to the 100% if there is malified intention and just leave it that?
So he's saying, it is still, there would be cases of subjective interpretation.
Coming to what Mr. Verma is saying, that this finance bill's proposal is a major initiative towards clarity and certainty. The last such revision with regard to concealment penalty was made in 1976. Prior to that, establishing mens rea was very important, was essential. Then they said furnished inaccurate particulars of income or concealed particulars of income. So in the furnished inaccurate particulars, mens rea was watered down. Now, they have, number one, reduced the quantum, and number two, have talked of two situations. One is underreporting, which is miscellaneous kind of defaults, and one is misreporting, which is, and again, they have specified both the circumstances in the particular provision. So I think it is definitely an advancement.
So we have heard our panelists, and one of the panelists rightly said that this budget is a clear departure from the past. When Mr. Arun Jaitley opened his budget speech, he said there are 9 key areas where the budget would focus on. So 9 is mine was the slogan. So the key areas are revenue augmentation, fiscal discipline, ease of doing business, rationalization of provisions, and on these several counts, government has done a fair job. From a common man's perspective, yes, the income tax slab remains unchanged, but obviously relief cannot be expected every year. However, there are some issues which requires reconsideration, like yet another black money voluntary disclosure scheme which can disincentivize both honest taxpayers and assessing officers. The inclusion of underreporting in the recast penal provisions which can lead to more potential disputes. However, the verdict is clear that there is a thumbs up to Budget 2016. That's the wrap of this episode. Thank you for watching.